If you've ever been uncertain about order blocks, supply and demand, and support and resistance, you're not the only one. They may appear alike on a chart, but they're entirely different tools, and confusing them can cost you real money. In this video, I'll explain the distinctions between these three concepts, how smart money applies them, how traders often get trapped, and how to pick the right tool at the right moment. By the end, you'll view your charts from a completely fresh perspective. Here's what you'll gain today. What order blocks are and the precise rules for identifying valid ones. What supply and demand zones represent and how to filter for the highest quality setups. What support and resistance levels are and the characteristics of the strongest zones. The difference between order blocks and supply and demand areas. The difference between supply and demand zones and support and resistance. How to identify whether a level is an order block, a supply or demand zone, or simply a support or resistance level. Real chart examples that highlight the differences side by side for immediate clarity. And before we jump in, be sure to like this video, subscribe to the channel, and tap the notification bell if you'd like to see more high-quality videos like this at no cost. See you right after the intro and disclaimer. Get ready, let's dive in. We'll begin with order blocks. In smart money concepts, an order block is simply the final candle that created market inefficiency, the area where large institutional players most likely place their decisions. Order blocks can appear at the start of a strong impulsive move or even within the middle of a trend. Sometimes it shows as a candle in the same direction, other times as one in the opposite color. To validate an order block, we follow three clear rules. It must generate inefficiency. Inefficiency occurs when price moves aggressively, leaving a gap between candle wicks. This reflects an imbalance between buyers and sellers. It must break structure or reveal a change of character. This is our first signal that the market could either continue in the same direction or reverse. It must be unmitigated. Order blocks are effective only once. We only take trades the first time price returns to that zone. Let's examine a real example of a valid bullish order block on the British pound, US dollar 1-hour chart. Price created a strong impulsive rally upward, leaving a clear gap between candle wicks. This imbalance, also known as inefficiency, indicates that smart money entered the market aggressively, pushing price so quickly that not all orders could be filled. This gap becomes a high probability zone where institutions may return to complete those unfilled orders. That same impulsive rally broke above a previous swing high. This break of structure confirms that buyers have seized control and are likely targeting higher levels. Without this break, the move could just be a temporary retracement. After the impulsive rally, price has not yet retraced to the origin of the move, which is the final down candle before the breakout. This shows the zone is still unmitigated. The fact that it remains untouched increases the probability of a strong reaction since institutional orders are most likely still resting there. When all three conditions are met, inefficiency, break of structure, and an unmitigated zone, we have a textbook order block that can be traded with confidence. To see the difference between an order block and the supply and demand zone, you first need to understand this ICT concept, the fair value gap. So what exactly is a fair value gap? It's a price imbalance that forms when the market moves rapidly in one direction, leaving an unfilled space between candle wicks. This gap highlights an area where price didn't spend enough time, meaning not all buy or sell orders were completed. Because of that, it often acts as a magnet, pulling price back for a retest. Skilled traders use these gaps to mark high probability entry zones, and when applied correctly, they can provide near sniper level precision in trading. How do you identify a fair value gap? Start by spotting a sequence of 3 consecutive candles. Look for a strong middle candle, one that clearly pushes in a single direction, positioned between 2 smaller candles. Here's the key. If the high of the first candle and the low of the third candle do not overlap with the middle candle, a gap exists. That open space between the first candle's high and the third candle's low is called the fair value gap. Once you find it, mark a rectangle over that zone on your chart. That becomes your area of interest. This applies in both directions. In a bullish case, the gap forms as price surges upward. In a bearish case, the gap appears when price drops sharply. Just remember, if there's no gap between the first and third candles, it's not a valid fair value gap, no matter how large the middle candle is. Now here's something crucial. A valid order block will always include a fair value gap. If there's no fair value gap, then it isn't a valid order block. The fair value gap confirms that smart money entered the market aggressively from that zone. Without it, the move lacks the institutional footprint, and we don't classify it as a true order block. A supply zone is an area on the chart where sellers step in with enough strength to prevent price from moving higher. It often develops after a strong rally when large players, such as banks and institutions, begin unloading their positions to secure profits. This wave of selling pressure forces price to reverse and decline from that level. In contrast, a demand zone is where buyers come in aggressively, halting price from dropping further. It usually appears after a sharp downward move, signaling that smart money is entering the market and pushing price upward again. Both supply and demand zones are critical reaction points on the chart, and they provide valuable insights for building high-probability trade setups. There are 4 key factors for recognizing a valid supply or demand zone. When institutions step in, they leave a footprint. One of the clearest signs is the size and momentum of the candles. If you see large, consistent candles driving strongly in one direction, that's smart money activity. But if candles are small, choppy, or filled with long wicks, that's just noise and weak momentum. Those setups should be avoided. Only trade zones that remain untouched. The first test is usually the most explosive. Once price revisits a zone, its strength diminishes and the chance of a clean reaction drops significantly. On lower time frames, like the 5-minute chart, you'll find many zones, but this filter helps you eliminate the weaker ones. A strong zone often emerges immediately after price breaks a significant level, such as a prior swing high or low. These breakouts aren't random, they are often engineered moves to grab liquidity, trap retail traders, and shift market structure. When a zone forms following such a breakout, it's a strong signal that smart money is in control. Never trade a zone unless it offers at least a 3-to-1 reward to risk ratio. If your potential profit isn't at least 3 times greater than your risk, the setup isn't worth it, regardless of how clean it looks. Why? Because over time, poor reward to risk erodes your trading edge. Discipline is what separates consistent winners from everyone else. So remember, large candles, fresh zones, a break of structure, and a minimum 3-to-1 reward to risk. These 4 filters form the foundation for spotting only the highest quality supply and demand zones. Now it's time to put everything we've learned into practice. Let's analyze a real chart example and determine whether the demand zone in front of us meets all the criteria for a high probability setup or if it's one we should avoid. First, the candles. Notice how we have large, strong, bullish candles driving in a clear direction with very few wicks. This is exactly the type of price action that signals institutional buying. Big players don't tiptoe into the market. They enter with size, and these candles make that obvious. Next, freshness. Has this zone been tested before? No, it's completely untouched. As we've covered, the first touch is usually the most explosive. Once a zone is retested, its strength diminishes and the chances of a clean bounce decline. Now, let's examine the structure. Did price break a significant level? Absolutely. It pushed above a previous resistance and formed new highs. That's not random. That's smart money engineering a breakout, trapping late sellers, and collecting liquidity. And finally, risk to reward. From this entry point, the setup offers a clean 4-to-1 ratio. For every unit you risk, you're targeting 4 units of reward. Even if not every trade works out, this math keeps your edge profitable over time. So, let's recap. Strong, clean candles, a fresh, untouched zone, a break of key market structure, and at least a 3-to-1 reward to risk ratio. This demand zone checks every box. It's not just a decent setup, it's a high probability trade that deserves serious attention. Alright, now let's break down the distinction between supply and demand zones and order blocks. As mentioned earlier, a valid order block must always include a fair value gap and remain unmitigated. That fair value gap is the footprint of aggressive institutional activity, and the unmitigated nature signals that the orders inside are still untouched. Here's an example. Look at this zone. Strong move, clear fair value gap, and price hasn't tapped it since it formed. That's a textbook order block. Now compare that with a supply or demand zone. A supply zone doesn't always need a fair value gap, and it can be mitigated, meaning price has already reacted to it once. That's a major difference. Let's make this interactive. Look at this chart. What do you think? Is this an order block or a demand zone? Notice the candles, the reaction, and the market structure. If you guessed demand zone, you're correct. Why? Because even though it's a strong reaction area, it does not contain a fair value gap. So, it cannot be classified as an order block. Let's try another. Look closely at this setup. Is this an order block or a supply zone? If you said order block, you nailed it. Here's why. It contains a clear fair value gap. Price has never returned to mitigate it, and it triggered a significant break in structure. That's everything required for a valid order block. So remember, order blocks must contain a fair value gap and remain unmitigated. Supply and demand zones may or may not include a fair value gap, and they can still be valid even if mitigated. Understanding this difference helps you filter out weaker setups and concentrate on the ones that truly provide an edge in the market. Now, let's move on to the third concept that many traders confuse with supply and demand zones and order blocks: support and resistance. So, what exactly are support and resistance levels? They are price areas where the market has previously shown a strong reaction, either rejecting the level or reversing completely. The key word here is potential. Just because price reacted there once doesn't guarantee it will again, but it might. That's why these levels matter. Why do we mark them on our charts? Because when price revisits these areas, they often act as decision points, places where liquidity builds. Traps are set, and smart money steps in to make a move. If you've already mapped these zones, you'll be ahead of the curve, ready to spot trade setups before the liquidity sweep even unfolds. But here's the truth. Not every line you draw on a chart is meaningful. Here's what to focus on when identifying high probability support and resistance levels. Clear swing highs and lows. Stick to the most recent extremes. The highest highs and lowest lows that stand out clearly. Multiple rejections. The more times price rejects a level, the more likely other traders are watching it, which means more liquidity sitting there. Obvious to the eye, strong levels should be easy to see. If you have to force it or squint, it's probably not reliable. Obvious levels attract retail attention, and that's where smart money hunts. Strong reaction or sharp move away. If price moved aggressively from a level in the past, that's often institutional activity. These areas can pull price back like magnets for a liquidity sweep. Role reversal. When a level has acted as both support and resistance at different times, it carries more weight. This flip traps traders and leaves stop losses behind. Recent market respect. Give priority to levels respected recently. Old zones lose importance as market conditions evolve. You don't need all 6 criteria for a valid support or resistance level, but the more boxes checked, the more likely it becomes a key liquidity area. And that's exactly what smart money looks for. Alright, we've covered support and resistance. Now, let's look at the difference between support and resistance, supply and demand, and order blocks. Check this chart. We see a clear supply zone. The move away is strong and breaks through a prior level. This isn't just a simple resistance line, it's an area where institutional selling came in aggressively. But is it a valid order block? Take 5 seconds to think. The answer is no, because it doesn't contain a fair value gap. Without that footprint of institutional imbalance, it cannot qualify as an order block. Now, look at the next chart. You'll see a resistance level. Why is this considered resistance instead of a supply zone? Because price was rejected twice and the level was recently respected. Why isn't it a supply zone? Because the move away lacked strength, the candles were small, showing no institutional activity. And why isn't it an order block? Because it's already been mitigated twice and there's no fair value gap. So, I hope this clears things up. You now understand the distinction between supply and demand zones, support and resistance levels, and order blocks. Now, let's examine another chart example. Here, we have a clear support level. It's obvious, recently formed, and recently respected. So why isn't it a demand zone? Because the move away from it is weak. The candles aren't large or decisive, showing that smart money isn't applying strong buying pressure here. That's why instead of drawing a zone, we simply mark a line. And here's why that matters. Smart money often treats an obvious support level like this as sell-side liquidity. They'll drive price below the line to trigger stop losses and trap traders. Then reverse, a classic liquidity sweep. If you had mislabeled it as a demand zone, you would have drawn a rectangle, watched price break through it, and assumed the level was invalid. In reality, the break was just a liquidity grab below support. The zone itself wasn't the setup, the sweep was. I hope this lesson helped you clearly understand the difference between order blocks, supply and demand zones, and support and resistance. That's it, traders. Thanks for watching this video. I hope you found this video informative and valuable. Don't forget to hit the like button, and if you're new here, make sure to subscribe and turn on notifications to stay updated with all our latest content. We genuinely appreciate your feedback and suggestions. So drop your comments below and let us know the topics you'd like us to cover in future videos. Your support means everything, and we look forward to seeing you in the next episode.